All right, welcome back to another episode of the Roadmap to Retirement podcast. I'm your host, Alex Neary.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neary, CFP, and guests are here to help you build your roadmap to retirement.
Lucas, I'm going to throw it right to you. Tell the people who you are.
Thanks, Alex. It's a pleasure being on. So my name is Lucas Wennersten. I own a firm called 49th Parallel Wealth Management. We are a cross-border Canada-U.S. comprehensive financial planning and investment management firm. The firm services people all over the U.S. and Canada. A lot of my clients have cross-border complexities. Either they've moved to Canada or they've moved to the U.S. That's not always the case. People inherit money on the other side of the border all the time. People inherit money in different currencies that they're not used to managing. I run into clients all kinds of ways. People move across the border for all different kinds of reasons. But my specialty is cross-border Canada-U.S. financial planning and investment management.
Okay, awesome. And the obvious follow-up question is, how did you get into doing that? Most advisors do not go that path. I know a lot of great advisors on the U.S. side. I've also gotten to meet some people that work in Canada and their advisors there. You've blended the two. There has to be a backstory, so let's start with that.
Yeah, to be honest, when I was younger, being in the Canada-U.S. niche was never really on my radar. I did have a family member who was a Canadian and had moved down and married one of my aunts. And so that's what put it on my radar. I made a career switch in my early 30s from the mortgage business over to financial planning. I had always wanted to be in financial planning. In fact, I had already done all my CFP, the Certified Financial Planner coursework, and I just hadn't sat for the test. I wasn't sure if I was ever really going to get back into the business because I've been doing mortgages and that was going well. I was basically recruited into the cross-border Canada-U.S. space. I finished my U.S. CFP and then moved on and got the Canadian CFP. And once I started doing the cross-border thing, it's very unique and you can be very creative with it because everybody's situation is different just in the domestic context. But when you throw the cross-border aspect into it, things get really complicated and it makes every situation even that much more different. So it's something I really fell in love with. I've always been into finance and numbers and stuff like that, but it's just something that really clicked with me once I started doing it. I've since moved on and gotten my chartered financial analyst designation as well. And so that's what all led me into opening my own firm.
Okay, cool. So this is, maybe I'm stupid, but I'm only a CFP in one country. So I never knew that was a thing until meeting you. Like I knew that there were CFPs in other countries, but is it that you actually have to sit for a second exam? Is that how that works?
Yeah, that's correct. The U.S. CFP board is the main CFP board. Other countries have had offshoots from that, but basically the goal is the same, is to teach comprehensive financial planning and to make people proficient in financial planning by the time you get done with the program. To be honest, I would say the Canadian test is actually a little bit harder because the U.S. test has gone to all multiple choice, and on the Canadian test, there's still fill in the blanks and structured response questions on there. And I think it also depends on which one you start with. For me, I'm from the U.S., and our systems have a lot of similarities, but there's a lot of differences as well. And sometimes those differences are minor, sometimes they're a little bit more significant, but they're similar enough where it can be very confusing. And so I got my U.S. CFP first. That's where my mind was still when I went into the Canadian exam, and I was working for a cross-border firm at the time, so I was getting experience in the cross-border niche, but it was just hard to pick up the differences and nuances because there are a lot of similarities. But yeah, every country that has a CFP, which there's a lot of them now, have their own exam and it's geared towards their own country. But that said, there's nothing about any tax treaties or any cross-border experience or expertise in any of those exams. So that's something that kind of comes with experience and working on the job.
The real world experience probably can't make up for anything on the exams. And so for myself, we talked about this a little bit off of before we started recording, off air, if you will. Living in Rochester, New York, working as an advisor in Rochester, New York, we're pretty close to Canada. And we do get a decent amount of people that are maybe moving here and that have Canadian assets. I can think of several people offhand that are in the situation. So I'm out on that end of it. I'm never on the other end of it because I'm not in Canada. I don't have U.S. people moving to me. But what are some basic things that people should be aware of if they are, let's just say they work 15, 20 years in Canada, now they're moving to Rochester, New York, or anywhere in the U.S. What do they need to know about their retirement accounts and some of the benefits that they've accumulated from Canada?
Good question. And leaving Canada is a huge part of the planning when it comes to cross-border stuff. First and foremost, there's what's called a deemed disposition when you leave Canada. And so what that means is that when you leave, on the date you exit, all of your assets are what's called mark to market. So whatever the value is of those assets on the day you leave, anything that's taxable or is considered non-Canadian situs property is going to be deemed disposed of, meaning that the CRA, which is the Canada Revenue Agency, which is their version of the IRS, basically pretends like you sold everything on that date. So any unrealized capital gains you have in taxable investment accounts, oftentimes this comes into play because people already have properties in the United States that are not their primary residence. And so those are also deemed disposed of. And so, as you can imagine, if you've been in Canada for 20 or 30 years or your whole life, that could be a pretty big tax bill if you've got some wealth. And so
That's a headache, but in a way, it's I wouldn't say it's good, but it's good in the sense that once you make it into the U.S., you have a higher cost basis, which is nice. But you also you have your assets held here, which would make your taxes simpler going forward. You get to just pay your dues, be done with Canada, and now you have everything owned in the U.S. Is that correct?
It's correct. In Canada, the tax brackets are much more compressed. And so in most provinces, you hit the top tax bracket at about 200,000 in income. So the way it works with capital gains up there is that they don't have preferred capital gains rates. It's not 15% or 20%, depending on what your income is. It's half of the capital gain is taxable as ordinary income on your tax returns. If you have $1 million capital gain and that turns into $500,000 of taxable income on your exit return, the top tax rate in most provinces is 50% or more when it's combined with provincial tax rates. And those tax bills get pretty big. Now, you mentioned coming down and having a stepped up tax basis, and that can be true, but from a US perspective, you only get a step up in basis if you actually sell the assets. So your tax basis, your original tax basis from Canada will carry over to the US unless you actually sell those assets. Now, you're not going to lose anything by selling the assets because they're deemed disposed of anyways. Plus, you're changing countries. You might want to convert some currency to US dollars. There's a number of other things you might want to do in the meantime, but you have to actually sell the assets to get the stepped up basis. But yeah, you're correct. You're going to basically start over, and your gains going forward from your entry date are what's going to be taxable in the US.
So it would be possible that if I own a position, let's just use a stock to make it easy. I bought stock XYZ for $1 back in 1970. 2025, I want to move to the US, so I'm going to pay tax on the gains there from Canada. But if I never sell that position, the US is still going to look at it as a cost basis of $1. So if next year I go to sell it, I'm going to pay tax on that gain a second time. Is that correct?
Yeah, and you'll still have some foreign tax credits that will roll over that you can use. So, unless you hold it for a significant period of time after that, because you're going to pay a lot more capital gains tax in Canada. So you'll have a good amount of foreign tax credits to use on that if you don't sell it right away.
Okay, but that sounds like a headache that's worth avoiding. So that's good, and I think people should definitely know that. So that's on what we would call the non-qualified side. So non-retirement accounts, capital gains. When we talk about retirement accounts, I know there's a couple different ones that are available to Canadians. How do I bring those over? Can I bring those over?
No, you can distribute them and you can take the cash and you convert it to US dollars, but there is no direct transfer from up there. They're called registered accounts instead of qualified accounts. So all their retirement accounts start with an R. So a registered retirement savings plan is the most common. It's like an IRA up there. So the first thing that you should know about moving to the US is that in the US, like in Canada, when you take a distribution from an IRA or an RRSP, it's fully taxable upon distribution because it's a tax deferred account. You got the deduction on the way in. That is how it works with RRSPs in Canada. So when you leave Canada, those RRSP distributions are no longer taxable on your Canadian tax return because you're not filing one. So it's different than the US in that if you're a US citizen and you move to Canada, you're still a US tax resident. You have to continue to file US tax returns. If you're a Canadian and you move to the US, you have that deemed disposition and then you sever tax ties with Canada. So you no longer are filing Canadian tax returns, but you can still take distributions from those Canadian retirement accounts. And in that case, they're going to it's going to switch to a withholding tax. So depending on how much you're taking out, your withholding tax will either be 15% or 25% from a Canadian perspective. From a US perspective, not all of your RRSP is necessarily taxable. And this really doesn't make sense, but this is just how it works. Your original contributions into the RRSP, even though you got a deduction on those in Canada, when you come to the US, those original contributions come out as a return of capital, so tax-free. Okay, so it's only really the growth, the unrealized gains that you have in the RRSP that are going to be taxable from a US perspective. And there's a strategy called crystallizing your RRSP basis. So basically what that means is that if you sell everything in your RRSP prior to entering the US, so if you exit Canada holding nothing but cash in the RRSP, then what that does is it steps up the basis in the RRSP so that from a US perspective, only the growth from your entry date is going to be taxable. So the growth will be taxable as foreign income, but everything that you have, the market value in US dollars as of your entry date will come out tax-free as well.
Okay.
So that's a pretty cool planning opportunity itself.
I can see how that keeps people like you employed. That's
Yeah.
a good niche to be an expert in. What about like a simpler? So we have a lot of people, not a lot of people, but let's say that there's a retired couple living in the US and their adult child is now living in Canada. They moved there, they're settled there, they're not planning on coming back. And you, a retiree who's done well, saved money, says, I want to gift some money to my son or daughter living in Canada. What's the best way to do that? Let's say if it's $100 at Christmas, that's easy. But let's say I've got $50,000 that I want to give to my daughter living in Canada. How can I do that efficiently?
There's no inheritance taxes or gift taxes in Canada. So in Canada, they have what's called income attribution rules. So what that means is if we're not at arm's length, so if I gift something to somebody in my family, essentially, if I gift them property and then that property is used to generate income, that income is going to be attributed back to me. But in the situation that you're talking about, the person that's doing the gifting is a US resident. They're not filing Canadian tax returns. So essentially, you might, if that money's invested, you might have some capital gains when you liquidate it. Like you're not going to be able to gift US mutual funds to a child in Canada, but if you just gift them cash, there really are no repercussions. They can take that money and do whatever they want with it. In fact, gifting in Canada has gotten a lot more prevalent because of housing costs. And I see a lot of my clients gifting their children funds specifically for down payments, particularly in places like Vancouver, Toronto.
Okay. What about logistically? This is probably a dumb question. It's not that hard. Do you just wire money to a Canadian bank? Is that all you would do?
Yeah, basically. I typically recommend the online platforms. Wise, there's another company called OFX, just because you get better rates with them. But essentially, anytime you're moving money, cash across the border, it can either be done physically, it can be done in the form of a check, or it's going to have to be a wire. You can't do an EFT or an ACH across the border.
Okay. So if I wire money to a Canadian bank account, I'm paying a fee for a conversion, I'm sure. Is that how they do that?
Yeah, there would be an embedded fee, but it's the spread that you really got to worry about. So at a bank, you're going to pay 2 to 3% probably in a spread. Somewhere like OFX or Wise, it'll be probably 1% or less.
Okay. And then, all right, let's kind of stick with the same example. So a retired couple wants to give money to their son or daughter living in Canada. Years go by, they gift, but then they unfortunately pass away, as we all do. And they've got, we'll call it $1 million left over, and it's going to go to their son or daughter living in a different country. Can that adult child inherit, we'll call it an IRA, and keep it in an IRA and take RMDs the way they normally would, or do they need to do something differently than the US?
No, the IRA rules are only the US rules apply. Okay. So in Canada, you can inherit that IRA. It's going to be an inherited IRA that'll stay at a US custodian. So that's one issue that you will run into in cross-border stuff, is that not all custodians like putting foreign addresses on different types of accounts. But anyways, yeah, the child will inherit the inherited IRA, and then it'll go according to the US rules. They've got a minimum distribution every year, and then it has to be out by the end of year 10.
Okay.
So that's actually one of the most beneficial ways of inheriting money from a Canadian perspective, is because you do have that extended deferral on that type of account.
Okay. And you would be paying tax on it at their US tax rate, or would the Canadian income come into play somehow?
It depends on if the beneficiary is a US citizen or not. Because if they're a citizen, they're going to be filing US tax returns. So any distributions that they make from that account will be fully taxable on their US return as well as their Canadian return. It's US sourced income, so the US will have first taxing rights on that. So you'll pay your US tax, and then you'll use that tax as a foreign tax credit on your Canadian return. If they're not US citizens and not US tax residents, so in other words, they don't have a permanent residency card that they're hanging on to or anything like that. So if they're not filing US tax returns, non-resident, the standard withholding for non-residents is 30%. But because of the Canada-US tax treaty, that's basically cut in half to 15%. So it'll be a 15% withholding in the US, but fully taxable in Canada. And then that 15% will be used to offset Canadian tax. But generally speaking, when you're taking a distribution that's taxable in both countries, almost always you're going to pay more tax in Canada. So it really doesn't matter. Like I talked about foreign tax credits, and it's just a matter of who do you prefer to pay the tax to? You know what I mean? As a the US side or the Canadian side. But at the end of the day, you're going to end up paying the Canadian rate.
Okay. That makes sense. I think the next logical topic, if we're talking about US-Canadian relations, is it'd be hard in today's environment not to talk about what's going on with the tariff stuff. Do you have any thoughts off the bat? I don't want to go too down the rabbit hole here, but what should listeners know about tariffs and what's going on right now?
I'm not an expert in international diplomacy, and I'm not a
Oh, you're
politician
not?
by
Okay,
any means.
never
But
mind.
in general, my preference is that both countries get along. I think in general, having cooperative trade and economic policies is best for both countries. I understand that there's some other issues that are at play here that are not necessarily financial. I'll leave that to the experts. But in general, what I will say is I see a lot more interest in moving across the border. It's not just on the U.S. side. If you don't follow Canadian politics, Justin Trudeau stepped down a few weeks ago or a month ago, maybe. He's going to have his last day in office here pretty soon. A guy named Carney is the one that won the Liberal Party, so he's technically the next prime minister in Canada. And this has all been related back to what's going on with Donald Trump and his administration and the tariffs and stuff like that. There's been a lot of upheaval in Canada related to that. It's a chaotic time in both countries, and it seems like the grass is greener on both sides right now because I get a lot of Canadians that want to get out and come to the U.S. and same thing vice versa.
Sure. One of the dangerous things about having a podcast and recording like this is there might be somebody that's listening to this in 6 months or a year, and what we're talking about now is either completely not relevant or you and I sound stupid for saying it a certain way. But it's interesting to see what could happen there going forward.
Yeah, definitely. I'm interested to see how it plays out.
It'll play. We'll see what happens. But if you're okay with it, we'll leave the Canadian stuff behind for a second. You had actually, I saw on LinkedIn earlier, you made a post talking about some of the parallels between the way that you treat your physical health, fitness, exercise, even nutrition, and comparing it back to your financial health, which is a connection I love to draw with people. I think there's just so many like principles that are the same on both. But maybe I'll start by just reiterating what you had said earlier.
The blog post that we put out today was talking about a study that's been going on for several generations where they're tracking family members. I think it was around 5,400 family members over 3 generations now, looking at the factors, health factors, social factors, monetary factors, and how those interrelate. And so they're being able to draw some more concrete lines between your social structure, who you surround yourself with, the type of attitudes and environment that you grow up in, as well as monetary factors, what kind of socioeconomic class are you in, health factors and things like that. So personally, I believe that there's got to be balance in everything in life, and everything does affect each other and is interrelated. From my perspective, it's 100% true. I can see it in a lot of my clients. Personally, I think stress comes into it a lot, where the poorer you are and the worse health you're in, the more stress you're naturally going to be under. There's a saying that stress kills, and I think that's true. I mean, it's important that everybody takes time for themselves and takes time to take care of themselves. So that was the motivation behind the piece this morning.
Yeah, I think that makes sense. When you think about some of the decisions maybe you and I get to make in our daily lives and compare that to what somebody at the very bottom of the economic chain have, if I'm worried about exercising every morning and going to the gym, and I'm thinking about eating organic food and drinking clean water, or I'm thinking about saving for retirement, all those things are a luxury to somebody that has all that stress you're talking about and doesn't get to be that picky, right? Like if you're starving, you don't care if it's organic or whatever. It just doesn't matter. So I think to your point, the stress is a big factor there.
Yeah. And to your point, also, there's a lot of places where they have food deserts where you really can't. It's harder to get healthy food. And a lot of people in those areas don't have cars. It's not like they can drive to a Sprouts or something like that. They're pretty much stuck with whatever they have around them. And by the same token, a lot of people don't have time to exercise. Some people are working 2 or 3 jobs, single parents and stuff like that. And exercising is not even an option. So
yeah, when you're trying
it is important.
5 kids by yourself, you're probably not worried about getting on the Peloton every morning.
Yeah, you're worried about making it to the end of the day.
Yeah, I could definitely appreciate that. Cool. We're getting to the end of our time here together. Is there anything else you want to make sure we cover? I want to give you a chance to do that as well.
On your last note, I just want to bring up the Canada-U.S. thing again in relation to our health system compared to theirs.
Sure.
Because I have lived in both countries, and it affects the way that you live your life, the way that you parent. So in Canada, healthcare is provided by the provinces. And so when I mentioned that the tax brackets are more compressed in Canada and that the combined rates between provincial and federal are higher in Canada, top rates, like in Ontario where I live, the top combined rate was 53.53%. And at that time, you got there at about 214,000, and that's Canadian dollars, right? So right now you get $1.43 or $1.44 when coming from US dollars. So the money's worth less. You get to those things are more expensive. If you put inflation in high gear for the next 10 or 15 years, that's where you would end up if you were spending Canadian dollars. But in regards to the stress, you do pay a lot more money in tax there. But before I went to Canada, I was working for a smaller company. We didn't have a group plan. My family was doing the Affordable Care Act. And our premiums for five of us at that time were about $2,000 a month. And the deductible was $14,000. It was incredibly expensive. And when you look at the comparison financially to how much I was paying in Canada versus how much I was paying in the US. Now, granted, when I went to Canada, I got a conversion, and so I was making more money when you look at pure dollars. But I think when I go back and look at how much the cost of living difference really was, it wasn't as bad as you would imagine just looking at tax rates itself, particularly because I had a big family. So every time we added somebody to the Affordable Care Act plan, it added more to the premium. But up there, I was the only one working. My wife didn't even have a work permit. So we could have had 20 kids and we would have been paying the same amount of tax. So in that respect, I would say Canada probably is more friendly to big families and to people who are in lower income brackets. But regarding healthcare, everything was free. So with my kids prior, we were paying the premiums and then we had to pay the deductible for each of the three kids we had prior. For my fourth child, when we were up in Canada, the only expense that we had for having that child was $400 Canadian, which we paid for a private room in the biggest hospital in Toronto. Not only is that a fantastic deal if you just look at what a room costs compared to hotels in the area, but the fact that was the only expense that we had was a huge relief compared to what we had been used to. And then just on a day-to-day basis with kids, if they break their arm or if you need to call an ambulance or if you need to go to the doctor or whatever, people get sick, there's no stress involved with it because immediately, like here in the United States, my kids start climbing trees and fences and stuff. And I start thinking, are you high enough to break your arm? Even if you fall, it's still going to cost me a couple $1,000s because I'm going to have to pay the deductible. I might have to pay for the ambulance and stuff like that. In Canada, it's just way different. So just in that one respect, I would say that there's less stress around healthcare in Canada versus the US.
Okay. Yeah, that's always the argument. And the counter argument to that is what? Is it I don't want to say this wrong. I don't really know. I'm just going off what other people said. But like the quality of care in Canada might not be as good. Like I've heard of people sitting on waiting lists for surgeries for a ridiculous amount of time. Has that been your experience, or is that just the politics?
Yeah, my experience in Canada was a little bit jaded, I think, because we went up there in July of 2019. COVID officially was in Canada in September. I had my child there in November, so we actually think we had COVID before they even knew it was a thing because we were all deathly ill when we came back from the hospital after that. But for emergency care, specifically for emergency care, I would say that Canada is very good. Regardless of where you're at, you're going to be able to get emergency care when you need it. It's not as good for routine care because it's harder to find primary care doctors. They do have kind of the equivalent of urgent cares up there. So that's what we used when we were there. But the reason I say it's jaded is because everybody was avoiding all the doctors. Unless you had COVID, you were not going to the doctor during that time when we were there. So every time we went, there was nobody there. We got right in, had great service. But I've heard other stories from other people, and particularly if you're looking for something like a knee replacement or something that they would deem to be elective or non-emergency, that's really when you can run into some of those long wait times. But again, it's free. So,
yeah, there's
depends on how long you got to wait, I guess, right?
Yeah, pros and cons to everything. I think most Americans can acknowledge that our system is not perfect, so there's changes to be made, and we'll see where that goes. But I do find it interesting the way you look at a more in-depth analysis of the tax differences. It's not just the tax rate you're paying, it's what do you get for that. We get a lot of people living in New York that they retire, or maybe before retirement even, they want to move to Florida because there's no state tax. And you really got to take a more analytical approach to like, how is it actually benefiting you? An easy example is I have a lot of retirees that they retire in New York State. They work for the state. So they have a New York State pension, which is not taxable on the state level. They have Social Security, which is not taxable on the state level. And they might have a small to modest retirement account, which some of those distributions are taxed at the state level. But they move to Florida or Tennessee or Texas with this idea that they're going to save all kinds of money in taxes. When you look at it, if they're a middle-class retiree, they're probably only paying a very small amount of state tax anyway. So it's not really the factor they think it is. So it's interesting to see the breakdown.
Yeah, one more quick tip or quick fact I'll throw your way is that if somebody's going to move to the US, in Canada, they have like Social Security equivalents. It's called Canada Pension Plan. They have another one called Old Age Security. So they basically have two different pension plans. When they move to the States, those are taxed as Social Security. When they're in Canada, they're fully taxable. When they move to the States, they get 15% of it free. So that's another kind of incentive to move down to the States. Also on the kind of on that same note about the pensions, the old age security has what's called a clawback in Canada. So basically, if your income is too high, they'll cut you off and they'll start clawing it back until you get to a certain income level, and then you get no more old age security. It's 100% taxed. So when you cut, no, it's so when you move to the States, you're no longer filing Canadian tax returns and they don't know what your income is. So the clawback does not apply in the States.
Okay, so there are some benefits to retirees coming to the U.S. Sounds
There
like.
are, but yeah, there are. But I agree with you in what you said. Oftentimes, especially after people retire, the difference is not as much. Once you get into those lower income brackets, you're going to pay more in Canada, but it's not as much as it would have been if you were working full time.
Yeah, I mean, we have retirees that are very comfortably living on $50,000 a year, and it's all coming from pensions and Social Security, and they're angry in New York State for the taxes. It's like you're paying $0 in New York State tax, but sure, move to Florida. I don't know.
Yeah.
It's sunny there.
Yeah.
But
Yeah.
anyway,
No,
we gotta wrap it up. Lucas, I really appreciate you coming on. Thank you for this. And any last words?
Oh, thanks for having me. It's been fun.
Absolutely. All right, we'll cut it there.
All right, Alex.
All right.
Take care.
It's always awkward.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.